go now to Michael Vogelzang. He is President and Chief Investment Officer of Boston Advisors. He helps oversee $1.7 billion in assets. Michael, let me ask you what you think about this market. We just talked with Jan Hatzius, Chief Economist at Goldman Sachs. He thinks we're going to see S&P 1500. That's his target, and we've been hearing the words melt up from a lot of people. Do we just continue this slow, steady, volumeless climb up?
It sort of feels like it, doesn't it? We don't think the odds actually support that, however. That's clearly sort of conventional wisdom at this point. But, you know, we just think that we've now really annualized the big bounce in earnings off the bottom from the recession in 08 and 09. We think that valuations are actually a little bit high. They're not ridiculous. Our best feeling about equity is that they're kind of neutral. There's not really a whole lot going on. We expect a little bit more disappointing or difficult earnings growth, and beyond that, you know, we think they're reasonably valued. So there's not a whole lot going. Would it shock us if it went to 1,500? No. I mean, hey, man, there's a lot of cash chasing this stock market at this point. The trend is very, very strong. So we could easily see 1,500. I just don't think it would be. It's a great bet to put your. I wouldn't borrow at 5.25% against the mortgage to put the money there for 1,500.
Let's probably head out to Bob Iaccino. He's founder and president of TraderOutlook.com. Bob actively trades currencies, metals, and stocks. Bob, where's the volume? What's going on? I mean, has everybody just gone home? What's going on here?
Everybody's gone home. They're done with this garbage now that Egypt is all settled. Everything's calm. It's kind of funny because the reason to buy equities to 1,500, as Michael said, is not really here. Again, I wouldn't be surprised if it melted up. But as an equity, as a long trader of equities right now, that's the way I've been trading equities since the beginning of the year. I want to look for a dip here. I want a correction. I desire a correction. If we can get 3 to 5% down from here, I'm at investor levels for my strategies. I'm at places where you buy and hold. Somewhere around 1,200 in the S&P. 1,320 is my first purchase level. We're almost getting there. So I'll be part of the volume that comes back in if we continue to trickle off as we have today.
Let me go back and ask about earnings here. And Michael, do you think that we're going to see a plateau? Does it concern you that if you think we're going to see a plateau in earnings growth from the trough? We've had pretty good growth, but it looks like from forecasts that in general S&P 500 corporate earnings are going to slow down.
Yeah, I mean, I think they're almost nowhere to go but slower. Doesn't mean they're going to crater. Doesn't mean they're not going to continue to do really nicely. Look, corporate America is performing on all cylinders. It's really cranking. There's absolutely nothing wrong. The problem is you're going to get natural slowdown after huge earnings growth from effectively, you know, the big huge earnings recession we had in 08 and 09. So we expect the gaudy numbers to slow down a bit. The real question is whether or not Wall Street finally catches up. Right. This whole period has been marked by Wall Street estimates being behind actual earnings growth. So we've had huge positive surprises consistently for the last, I don't know, 6 quarters, 8 quarters. And when does Wall Street actually catch up? We think they're getting close. We think there are going to be fewer upside surprises next quarter, probably the balance of this year. Part of our thesis as to why markets are reasonably valued and won't be roaring to 1,500 anytime soon.
Hey, Michael, it's Julie here. I mean, forget about earnings versus estimates. I'm curious also about earnings growth, especially when you look at it versus sales growth, because sales growth is expected to pick up as the economy continues to expand. So what are you going to see happen to margins as you look at these trends in earnings and sales growth?
Well, you know, we've spent the last 18 months really getting income statements in line and shaped up. So if we see revenue growth, we should see some real margin expansion. You've seen that already in many, many companies that sell overseas, because that revenue actually has been pretty strong, obviously selling to the BRIC countries, even to Europe in some cases. So those folks that have a more global client base or product base have been doing really nicely, and you've seen margin expansion in some of those. The real question is the folks who sell domestically. The countervailing argument to what you just mentioned is, of course, raw material prices. You know, with cotton up at all-time highs and some of the other raw materials getting very expensive, the question is what kind of cost pressures are these folks going to see, and will slightly increased revenue be offset by margin pressure from the cost side?
Hey, Bob, let me ask you, because we heard earlier from Michael, there's a lot of momentum here. We hear from traders that we talk to in Chicago a lot. This is all about momentum trade. How much do earnings matter, or do they only matter when you have a miss or a tremendous beat?
Well, I think Michael, again, brought up a great point. The earnings it almost seemed like Wall Street analysts were afraid to put out the earnings they thought might be achieved with the easy money and the sort of tenable expansion that we had 6 to 8 months ago. And now that the expansion has kind of taken hold, you're still seeing these sort of tepid earnings estimates from Wall Street, and I think the street, the actual results, are going to come down to meet those estimates. But again, from the momentum standpoint, if we get a pullback, the vast majority of traders that I speak to are still looking to trade equities from the long side. They're still looking to trade commodities from the long side. People will buy crude down to $77 for a trade. They'll buy gold down to $12.50 for a trade. So that whole buying momentum is in place. I just feel it's like it's a pullback away from gaining steam again and giving us that second wave up for this year.
Hey, Bob, it's Dominic here. One of the things that a lot of people are keen on today is this weakness or perceived weakness in emerging markets. A lot of people saying that it's been toppish. It hasn't been participating here. So are people going to once again kind of buy these dips here, or do you think the emerging markets trade has pretty much run its course for the time being?
I think the emerging markets has run its course for the time being. I think the money is flowing back into the U.S., not at the pace you'd like to see. Again, the volume hasn't quite been there versus previous recoveries. But the money has been predicted to flow back into the U.S. It has been flowing back into the U.S. So I think for now it's pretty much run its course.
Hey, guys, you know what I want to ask you? Because we have spent so much over the last couple of days talking about the president's budget, the deficit. I mean, when do we start to tackle that or need to tackle it? And, I mean, do the markets even care that we do? Bob, take that for me. I mean, you're out there in Chicago. I mean, do you guys even care about what the president has to say about the budget and about the deficit?
A lot of traders are worried about Q3 and especially Q4 of this year. You don't find many traders down here thinking that we're going to have a 15 or 20% year by the end of the year. But again, Chicago, the type of traders that I speak to on a daily basis, short to medium term, they're not looking at it right now. They're all saying that nobody wants to utter the big negative conversation about cutting entitlements. Neither party wants to do it. They're both waiting for the other to do it. We're in that silly 2-year election cycle again, going into 2012. So again, it's not really, traders are worried about Q3 and Q4, but they're not really concerned for the time being.
Michael, what about strategists? I mean, how does any of this play into your thinking when you're looking at the outlook for the markets in terms of the budget and the deficit specifically? How does this play into it?
You certainly can't trade on budget talks, right? I mean, we don't have any idea what's going to happen in the short run.
Right.
We think it's critically important for the competitiveness of the U.S. economy for the political jerks to get off their seats and get some work done here. Why is this complicated? Right, we're spending a bigger piece of our GDP in deficits than we almost ever have. This is not a difficult problem. It's simply political will. We don't understand it. We're not happy about it. This business, the financial future, the financial competitiveness of the United States, from a manufacturing perspective, from an education perspective, on and on and on. Depends on whether these guys get their act together. And it really annoys the living daylights out of me, as you can probably tell. There's a lot of folks in our office who are feeling the same way. A lot of people in our industry feel the same way. Again, this is different from, is the market going to run to 1,500 this week?
Right.
But it matters a lot. It matters a lot to the country. It matters a lot to the people who don't pay attention to quarterly earnings estimates. This stuff has to get fixed.
You know, Michael, I think I'm going to cut that as a soundbite and play it every day before we kick off our broadcast.
It's refreshing.
Political jerks, that is refreshing. You're just cutting right to it. I love it. Hey, Bob, Michael, thank you so much. We appreciate you joining us this afternoon. Take care, guys.